Hey, greetings. Welcome to our summer 2025 market update. Hope everyone is doing well. Hope you're enjoying your summer. Kevin Underwood is off this week on a much needed vacation at Young Life Camp with Katie and his daughter. So just me today. Hey, you know what? People ask me a lot, especially during periods of market volatility, if our phone rings a lot. Like, oh, you must have a lot of worried clients. And the answer is no, we don't. I mean, we have concerned clients, probably like every financial advisor does. But I'm really proud to say, because today we're going to review some of the volatility we've been through this year in the first half of 2025. Really proud to say that our phone doesn't ring a lot for that reason. Rings for normal reasons like need to put money in or take money out or need to schedule a review meeting, things like that. So really glad that most of our clients, if not all of them, are trusting the process. We really do want to help our clients become the most resilient investors in the country. Not exactly sure how you'd measure that, but we're going to review some of those ideas today. A lot of what we'll talk about today is stuff that we pay attention to on a daily, weekly basis so that you don't have to, but it sure is nice, hopefully, for you to get an update every few months here as to kind of what's going on and the things that we're thinking about. So I'm excited for the material we have today. So let's get started. First of all, where have we been? It's certainly been a tumultuous, at times chaotic first 6 months of the year. The S&P 500 was down almost 20%, about 19% and change from February to early April. The news a few months ago back then was full of a lot of chaotic information about Trump's tariffs and what's going to happen if the administration does this or does that. And I was thinking about this the other day, 3 months later, do we really have that much more information? Kind of, but not really. It almost feels a little bit like Y2K, which is a long time ago, but Y2K was kind of like what's going to happen to the computers and therefore our society when the date, the year column in the date field has to go to 00. And the answer was not very much. And so I don't want to minimize any of the potential economic issues that our country faces because some of them are significant. But the reality is the market has reacted pretty well. It's up a staggering 24% roughly from early April. If we want to use the S&P 500 as a measure of large cap domestic stocks for U.S. investor, that S&P 500 index is also up about 5% year to date. And so it's been a good first half of the year, tumultuous as I said for domestic large cap equities. We always look at other major asset classes in these market updates, other items and asset classes that might be a part of your portfolio. Quietly, it's been an outstanding year for international equities, up 15 to 18% through the end of June. Small cap equities and most of the major bond indices are relatively flat for the year. So, some investors we find, other people that we talk to, maybe prospective clients, maybe some people in our network, just other people we talk to about investing, they will sometimes abandon a proper, robust, comprehensive asset allocation that might have several of the components that I mentioned. They'll abandon that asset allocation in favor of kind of the hottest asset class with the best performance. What has that been over the last 10 to 15 years? For the most part, you could call it large cap growth as a broad asset class. You could call it the technology sector if you wanted to get into a specific sector of the S&P 500 index. But, we think and we hope and we believe that viewers of our market updates will remember lengthy periods of time where the hot asset class does not perform very well at all. And so if you have too much money in a hot asset class and then you ride it through a time where it's down for a lengthy period of time, then as an investor, that can obviously require you to invest additional funds needed to reach your financial goals, versus you many times could have reached your financial goals sooner or safer just by staying the course and following your financial plan with a well-balanced portfolio. Obviously, one of the goals of investing, not the only goal, but one of the goals is for your money to work harder so that you don't have to. So that's certainly why we believe in asset allocation and diversification. This is a slide we look at often because it needs to be reviewed often. Volatility is so normal, so common. But it's tough to get comfortable with that emotionally, I think, for the average investor. Just as a quick recap on how this slide works, the gray bar is the return of the S&P 500 index for the entire calendar year. So going back to 1980, you can see most of the gray bars are positive. In fact, 34 out of the last 45 years, the S&P 500 has had a positive return. 11 of those years, about a quarter of the time, that's why we say 3 up, 1 down, about a quarter of the time the S&P 500 has had a negative return. The average intra-year drop, or just the decline from peak to trough at some point during the year, is about 14%. So what does that really mean? That means a 6,000 point drop in the Dow would be considered normal, as in annual, regardless of what the news says as to the reason or why it happens. So as you can see from the far right, through the first 6 months of the year, the S&P 500 index up 5%. We did have that 19% decline from February to April that we just talked about. So this is a good chart that hopefully builds some resilience to help you just kind of keep shrugging your shoulders at the market and going about and living your life. You know, looked at another way, this is probably a little bit more justification for doing that. If we focus mostly on those peak to trough declines of 10 to 20% since World War II, the large majority of those declines are in that range, 10 to 20%. We find that the average recovery is only about 4 months. So another saying we have around here is and we all know that past performance is no guarantee of future results. But historically, the market has not taken decades to recover. From the most significant declines, sometimes it'll take a few or several years, but in most of the declines, it takes a few to several months. So hopefully this provides a lot of freedom in our decision making and just lets us stay focused, encourages us to stay focused on our purpose and our financial plan, and a little bit less on our portfolio balance. If you really want to know a lot about how we advisors, look at the markets and investments, this is a really good slide that illustrates this. What's going on here? We got 3 colors: green, blue, and gray. This is the range of stock, bond, and blended total returns going back to 1950. So the green bar on the left, where it says 1 year at the bottom, that is the 1 year range of returns. So worst 1 year ever in the stock market, down 37%. Largest 1 year ever, 52%. Worst year in the bond market, down 13%. Best year in the bond market, up 33%. The gray bar is about a 60-40 portfolio stock to bond mix. Worst year ever, down 20%. Best year ever, up 34%. If you just look at relatively short 5-year rolling periods, almost all the negatives, as you can see to the right, start to go away. Your worst 5-year period in the stock market since 1950, you were down 2%. Worst period in the bond market, down 2%. Worst period in the 60-40 portfolio, up 1%. Now, nobody likes to go through a 5-year period, whether you're a stock investor, a bond investor, or a mix. Nobody likes to go through a 5-year period not making any money. But history suggests that the range of expectation, the range of expected returns would be that it would suggest that the worst 5-year periods, we might come close to breaking even. And then the best 5-year periods, we would do pretty well. Obviously, as I just said, past performance is no guarantee of future results. But the assumption would be that if the markets continue to operate as they have been for decades and decades and decades, and it is our opinion that they will continue to, that anytime you go through a bad 5-year period, you are likely to make those returns up. in a 5-year period that would follow. Let's take a look at this table as we make our way through this update. It's not always that easy to have a 5-year picture or even a 5-year perspective on our investments. The 10-year and the 20-year versions of the chart we just looked at look even better, but I think most of our clients here at the Pure 4 Wealth team are retired. So hopefully they have 10, 20 more years, but we certainly have some clients that don't have that long. And they remind us of that sometimes when we get too, forward looking or our perspective is too long term in their opinion. And so we understand that it's just not that easy. This table shows essentially almost every decline of 20% or more going back to 1950. There's some that are kind of in the 19% range. And just look at some of these percent losses and the number of days it took for that loss to happen. I mean, 1973, 1974, you had a 48% decline that took 630 days. In 1980, you had a 27% decline that took 622 days. In 2001, 02, you had a 49% decline that took 929 days. That will test a lot of patience. In 2007, 2008, early 2009, you had a 57% decline that took 517 days. Even in 2022, you had a 25% decline that took 282 days. So the market will certainly test all of us, which is one of the reasons we're here and one of the reasons we do these updates. Yet, I would ask today, what other liquid investment option do you really have to put your money in? There's a reason we use cash and money market funds for short-term goals. By short-term, we'd say over the next 1 to 2, maybe 3 years. But what other liquid investment options do you really have to put your money in that help you stay ahead of inflation? And when we're talking about liquid investment options, we're not talking about commodities that are a little bit more of a gamble on how prices will fluctuate over the short term. And we're not talking about illiquid investments, even though there's plenty of good, decent, worthy illiquid investment options out there, whether it's a small business, whether it's real estate. We're talking about liquid investment options that help you grow your portfolio towards a goal like retirement, and that you could then withdraw retirement income from. Just remember this table. It starts in 1957 when the S&P 500 was at 49, and now here today, recording this in early July, the S&P 500 sits at over 6,200. Remember, this is not just a stock market. Remember, this is really a proper portfolio is a diversified investment in the most innovative companies in history. And with the right diversification strategy, the portfolio continues to add more money to the successful companies while taking money away from the less successful ones. This is the simple and inevitable genius of what your portfolio can do for you. And not only is it simple and inevitable, it's, in our opinion, absolutely necessary to stay ahead of inflation. In recent news, the last just a few days, as the big beautiful bill just passed, it's becoming perhaps more and more likely that our federal government will again seek to print their way out of debt over the next several years. That might be the only option they will have. This is not a criticism, but this is really just more of a reality of how Washington, D.C. has been operating, not just for years, not just in recent memory. This has been going on for decades. You might remember, viewers of these market updates might know that we've actually discussed this before. The last time our government debt as a percentage of GDP, gross domestic product, a measure of our country's productivity, but the last time our government debt was this high as a percentage of GDP was post-World War II. And while I don't want to take time today to update, to discuss all the economics of it, but back then, the government really only had a couple of ways to reduce debt. And one is obviously taxes, and the other one is inflation. And for every year that inflation exceeds the rate that the government has to pay on its debt, that's a gain for the federal government. And so this is not so much of a conspiracy theory or a political comment as it is just pure economics. So we'll probably discuss this at our next market update, but let's just suffice it to say that for today, your portfolio returns better exceed inflation by a good bit if you were going to reach your financial goals, whether you are attempting to work towards retirement or already in retirement and want to stay ahead of inflation and provide a standard of living for yourself. You must exceed inflation in the United States of America, or really rather in any capitalist country in the world, to be able to reach your financial goals. So despite all of the ups and downs in the previous table and the growth trend over the long run of domestic and really international stock markets, retail investors, the average retail investor still really struggles. Here's a fascinating case study. I've seen some information on this in previous years. I've not seen something this comprehensive. This is a strategist at JP Morgan found that the average retail investor returned only 5.5% over the last 10.5 years, going back to 2015. Now, during that same time frame, the S&P 500 averaged about 12%, and even a more well-rounded asset allocation was in the 9 to 11% range, almost doubling the average retail investor's return. Now, you might say, how are they measuring this? It's actually not that difficult. Without boring you with all the details, they just simply measure inflows and outflows in various funds, especially broad market index funds that would attempt to capture the, since those are the instruments used by the huge majority of retail investors, it would essentially capture not any one person's investment return, but it would capture the average retail investor return. So if you are staying the course, not getting freaked out, and focused more on your plan than your portfolio, count yourself today blessed in order to be able to do so. Because what this chart shows is that you are normal, but you are not common. Common, as my friend and the author Chip Dodd says, so often what is considered common is also considered normal, when in actuality, common is what is frequent and normal is how we are made. It's kind of like what we've said before and so often say, we can all be better investors the more we apply our lessons learned in life to our investing decisions. The lessons of perseverance, faith, fortitude, staying the course, not giving up, and hoping for the best and a brighter tomorrow. Because investing is a lot like life, but with more financial risk, which makes it very scary. You know, here on the Purifoy Wealth team, if you're a client of ours, our goal is pretty simple. Our mission is we want to help our clients reach their full potential in life. I cannot recommend this podcast from my good friends, Brian Barley and Dr. Chip Dodd, enough. They do a great job discussing life, work, relationship, and emotions. It's a real great resource for anyone seeking to live a full life, successfully navigate their way with wisdom and heart, and keep growing in the hope and knowledge that we were born with and long to keep as we make our way through life. So depending on where you are with your summer listening, your summer reading, I hope you'll check it out. And it just reminds me that, you know, our opportunity as investors is to be uncommon, but very, very normal. That is focused on what the future that we keep dreaming about, continuing to invest towards that in life, but also financially, and keep building our faith as we pray through what we're seeking in life for our future. So thank you for joining us today. We hope you've enjoyed it. We'll be in the office if you have any questions about any of the material we covered or anything else. We're always a phone call or email away. Thanks again. Talk soon.